The number most retirement calculators give you is wrong. Not slightly wrong. Wrong in a way that has caused millions of people to work years they didn't need to work, because every mainstream tool is calibrated for 65, not 55. And the gap between those two numbers isn't 10 more years of savings. It's a completely different financial architecture with different tax rules, different risk profiles, and different legal provisions that nobody in an HR meeting has ever clearly explained. And there is a specific IRS provision buried in the tax code that lets you access your retirement accounts penalty-free before 59 and a half legally, without gimmicks that most people targeting early retirement have never heard of. That's where we're starting today. My name is Tom. I run Lazy Investor. I have multiple hundreds of thousands of dollars invested. This is not theory. 10 plus years running my own business, surrounded by accountants and fiscal lawyers who taught me how money actually moves, which turns out to be very different from how financial marketing says it moves. Today, I'm giving you the real plan for stopping at 55. Not the vague version, the structural one. Here is the first thing you should probably know. Roughly 46% of Americans leave the workforce earlier than they planned. Not because they chose to retire early, because of a health issue, a layoff, a company restructure, a caregiving situation that consumed their life nearly half. Which means if you're 52 right now and planning to work until 62, you are statistically flipping a coin on whether you even make that decision voluntarily. Building a plan for 55 isn't ambition. It's insurance against someone else making the decision for you. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They're calibrated for 65 and they don't account for the healthcare gap or the early withdrawal mechanics. Specific to retiring before 59 and a half. It uses BlackRock and Vanguard methodology to expose the actual weak points in your plan. And I only ask for your email to send the report because I don't store any of your financial data. Link in the description. Here's the image I want you to carry through this entire video. Picture a two-engine plane. For the last several decades, you've been flying on one engine. Your job, your salary, your earned income. It works. Millions of people fly this way their whole career. But one-engine planes have a structural problem. The moment you want that engine to stop, there's nothing else holding you up. Retiring at 55 means your second engine, your investments, your structural income, your designed passive cash flow has to be powerful enough to carry the plane completely. Not assist, not supplement, carry it. And the entire retirement industry is structured to help you make the first engine bigger, not to help you build the second one. Every time I come back to this image today, it's going to mean something slightly more uncomfortable than the last time. In a few minutes, I'm going to show you the 4-level structure that separates people who successfully exit at 55 from people who are still saying 2 more years at 63. But first, I need to show you why the conventional math is more broken than you realize, and why that brokenness isn't exactly an accident. Here's the assumption embedded in almost every retirement calculator you've ever touched. You retire at 65. Social Security starts near your full retirement age. Medicare kicks in. Your income floor covers a meaningful portion of spending. You need to fund maybe 20 to 25 years of expenses. That model, that's what the whole industry calibrates to. Fine for 65. Disastrous for 55. Because when you move the number 10 years earlier, almost every assumption breaks simultaneously. Your Social Security full retirement age, depending on your birth year, is 66 or 67. And if you wait until 70 to maximize the benefit, which increases by roughly 8% per year from full retirement age to 70, you're potentially looking at a 15-year gap from 55 to 70, where that income is zero, not reduced, zero. Your second engine has to fly completely alone for 15 years before the income floor even materializes. Run your calculator with that gap and see what number it spits out. It's a different number than what they showed you at the benefits meeting. Medicare starts at 65, full stop. Retire at 55, and you have 10 years of private health insurance to fund from your own pocket. The average annual premium for a 55-year-old couple in the United States right now runs somewhere between $22,000 and $24,000 per year. And that's before deductibles, before copays, before the thing that happens to most people after 50 that they didn't budget for. 10 years of premiums alone is potentially $240,000. That's real capital your plan needs to hold, and most calculators never surface it unless you know to ask. Then there's the withdrawal problem. Standard retirement accounts, your 401k, your traditional IRA are designed for 59 and a half and beyond. Touch them before that without a specific strategy, and you owe a 10% penalty on top of ordinary income tax. If most of your wealth is sitting in tax-advantaged accounts and you retire at 55, you have a liquidity problem that can force bad decisions at the exact worst time. Except, here's what most people have never heard. Two legal, clearly documented ways around this exist in the current tax code, and neither one requires a lawyer or a complex scheme. The first is the rule of 55. If you separate from your employer during or after the calendar year you turn 55, you can take withdrawals from that specific employer's 401k penalty-free. Not from all accounts, from that specific plan. Which means, if you're targeting 55 as your exit date, keeping your final employer's 401k separate from any rollovers is a deliberate strategic decision, not an oversight. Roll it into an IRA prematurely, and you've eliminated this option entirely. That's the kind of thing nobody mentions at the annual benefits enrollment meeting. The second is SEP, substantially equal periodic payments, also called the 72T rule. This provision lets you set up a fixed withdrawal schedule from an IRA before 59 and a half, completely penalty-free, as long as you follow the rules for at least 5 years or until you hit 59 and a half, whichever is longer. It's not flexible once you start it, which is why it requires real planning, but it exists. And the number of people who say, I can't retire at 55 because my money is locked up, who have never heard of either of these provisions, would genuinely surprise you. You think the problem is not having enough money. The actual problem is not knowing the architecture. Those sound similar. They are not. One is a math problem. The other is an information problem. And information problems are cheaper to solve. Now let me introduce someone here because abstract concepts get slippery fast, and I want you to see this on a real human being. His name is Marcus, 53 years old, senior engineer at a mid-sized manufacturing company in Ohio, married, 2 kids done with college, mortgage about 3 years from being paid off completely. He has roughly $850,000 in retirement accounts and another $120,000 in a taxable brokerage account. His house, when it clears, will be owned free and clear. By almost every benchmark, Marcus is doing well, better than most. He knows it intellectually, and yet Marcus thinks he needs to work until 62, maybe 63, because the number in his head, the number he got from a financial advisor meeting in 2018, is $1.5 million, and he's not there yet. I'm going to come back to Marcus because his situation is going to show you something specific and important. Hold that. Now, here's a story that makes the most misunderstood retirement risk concrete because people hear the phrase sequence of returns risk and their brain slides right off it. Back in 2008, a school teacher in Vermont named George retired at 57. If you know your market history, you know 2008 was possibly the worst year in recent memory to retire voluntarily. The S&P 500 fell roughly 37%. George watched his $600,000 portfolio drop to somewhere around $400,000 in less than 12 months. George was fine. Not because he was lucky, not because he called the market, because before he retired, he had built a 2-year bridge cash, short-term bonds, stable instruments that covered his spending gap for roughly 24 months without touching a single equity position. While markets collapsed around him, George lived off the bridge. He didn't have to sell anything in a downturn. By 2010, his portfolio was back above where it started. He retired on schedule and stayed retired. His neighbor Frank retired 6 months before George on a roughly similar portfolio. No bridge, stock heavy, all growth allocation. Within 18 months of retiring, Frank was forced to sell equities at depressed prices to cover monthly living expenses. He hit the double impact that destroys early retirements, falling prices, and mandatory withdrawals simultaneously. That combination doesn't recover well. Frank went back to part-time work at 61, not because he ran out of money, because he scared himself into bad decisions in a bad sequence and couldn't stop the spiral. Same market crash, same approximate portfolio size, completely different outcomes. The variable wasn't savings rate, wasn't investment genius, wasn't luck, structure. This is the second engine metaphor, arriving somewhere darker. George had built and tested a second engine before cutting the first one loose. Frank assumed his second engine would hold because it had always been fine before. Those are different postures entirely. One of them gives you a retirement. The other gives you a very expensive lesson in timing. By the way, hit subscribe if this is landing for you. Otherwise, the YouTube algorithm may genuinely never surface my content again. That is not a rhetorical device. That's how recommendation systems work. Now here is what nobody is actually telling you. This is where the video shifts. The people who consistently retire at 55 are not doing something exotic. They're not running sophisticated option strategies. They're not early crypto adopters who got lucky on timing. There are people who figured out, usually somewhere in their mid to late 40s, that there are two entirely different financial games, and you cannot win the second one while playing the first one. Accumulation is the first game. Maximize return, take appropriate risk, beat the benchmark, compound aggressively. Distribution is a completely different game. It is not accumulation in reverse. It is an entirely different sport with different win conditions. You win accumulation by having the highest number. You win distribution by not making the one mistake that crashes the plane. Those are not the same objective. And the entire industry, its products, its fee structures, its marketing, is designed for accumulation, because accumulation is where the assets under management fees live. Distribution is where you stop needing them. Here is the 4-level structure. Hold this, because this is the architecture. Level 1 is your income floor, guaranteed income, non-negotiable. Social Security at full retirement age or beyond, a pension if you still have access to one, and statistically fewer people do every year, an annuity you deliberately purchase with a specific gap in mind, clean rental income after all real costs. The question at level 1 is simple. What income shows up no matter what markets do? For most people targeting 55, the honest answer is nothing yet. That's fine. Level 1 is a future asset, not a current one. Plan for when it arrives and size everything else around the gap it creates in the decade before it does. Level 2 is the bridge bucket, cash, short-term bonds, Treasury I-bonds, FDIC insured instruments. Stable assets that cover your spending gap for 2 to 3 years without requiring you to sell anything volatile. The bridge bucket is not an investment. It is insurance against sequence of returns risk, which, as George and Frank demonstrated, is the single most dangerous threat specific to early retirement. You don't complain that homeowners insurance costs money without generating returns. You pay it because the downside it prevents is catastrophic. The bridge is the same logic. Its job is to buy you time while markets do what markets do. And once your brain knows the bridge exists, the noise around market volatility stops being terrifying and becomes more or less irrelevant. The bridge removes the first punch, and the first punch is the only one that actually matters. Level 3 is the growth engine, your stock portfolio, your index funds, your long duration assets. The money that doesn't need to care about the next 2 years because it isn't going to be touched for 2 years. This is what generates real returns over 25 years. And the thing about level 3, when properly separated from level 2, is that you can leave it entirely alone during corrections. Because the bridge is handling the short term. Level 3 gets to be genuinely long term, which is the only condition under which equity investing actually works as designed. Level 4 is the income kicker. Optional, non-mandatory income that doesn't require your full labor. Consulting, writing, freelance work in your area of expertise, dividends from a taxable portfolio managed for income, a rental property with real cash flow after maintenance, vacancy, and taxes. The income kicker is not the plan. It is the flexibility layer. If markets have a rough year in retirement, you do one consulting engagement instead of selling stocks at a bad price. It also does something that purely passive retirement doesn't. It gives you agency. You're not depleting a pile, you're participating in something. That psychological difference is real, and most people underestimate how much it matters to men who've spent decades being productive. 4 levels: income floor, bridge bucket, growth engine, income kicker. Build them in this sequence. Fund them in this priority. When all 4 are in place, you have a system that doesn't require you to be right about any single market variable, only to have a structure. That's it. That's the whole architecture, okay? Now, let me say something about the financial industry that is going to sound conspiratorial, but is actually the most boring thing I'll say today. Follow the incentives. Imagine a meeting. A 53-year-old walks in and says he thinks he might be close to retiring. The advisor runs the projections, slides them across the table, and says, "You're going to want a bit more runway. 3 more years." Almost always 3 more years. Ask yourself, who benefits from 3 more years? The client? Maybe. The advisor? Definitely. Because the fee is a percentage of the assets under management. More years of work equals larger balance equals larger annual fee. Let me put numbers on this. If Marcus has $1 million invested and pays 1% per year in fees, and 1% is not unusual, it sounds basically like nothing that is $10,000 every single year. Not on transactions, not on performance, just for the privilege of having someone manage the pile. Now compound that against him. If his portfolio grows at 7% before fees and 6% after fees, the difference over 20 years is not 20% of $1 million. Thanks to compounding, a 1% annual fee on $1 million over 20 years translates to approximately $350,000 in lost final balance. $350,000 not gone to market risk, not gone to inflation, gone to something that was presented as just 1% in a room with comfortable chairs and a projector showing lines going up. They show you the line going up. They don't show you the shadow line, the one going up 30% less, because the shadow line is where the fee lives. And now you understand the incentive structure perfectly. Every year, Marcus works. His balance grows. The fee is a percentage of the balance. Keeping Marcus at the table, nervous, feeling not quite ready, perpetually 3 years from safe, that is business. Not evil, not a conspiracy, incentive compatible. And incentive compatible is the most dangerous kind of problem because nobody has to do anything wrong for it to run forever. There is an entire ecosystem of financial anxiety built on the premise that you need more, that you're behind, that retirement is more complicated and more dangerous than you can manage without help. And some of that help is genuine and worth paying for. But the fee structures, the complexity of the language, the focus on impressive sounding simulations rather than clear trade-offs, these are features, not oversights. Complexity sells products. Clarity ends conversations. Now, here's something genuinely funny that happens every time someone starts talking honestly about retiring at 55 at work. The moment you mention it, someone will say, and I promise you this without exception, "must be nice," in a tone that implies you've won a lottery, not that you've been structuring your finances deliberately while they were financing a boat on a home equity line. Must be nice. Yes. Intentional planning tends to be. And the second predictable conversation is with the advisor who says, with complete sincerity, "We want to make sure you have enough runway." And then the projection shows you need to work 3 more years. It is always 3 more years. It doesn't matter what you walk in with. The answer is 3 more years. I am convinced this number is generated by a button that says add 3 years somewhere on the software. And nobody has ever questioned why that button exists. Now, let's talk about the real enemy. Because naming it clearly is half of the plan. The villain is not the stock market, not inflation, not uncertainty. The villain is what I'd call the invisible finish line, and it is a psychological technology as much as it is a financial one. There's documented research in behavioral economics showing that high earners, even objectively well-positioned high earners, consistently believe they need roughly twice their current assets before they're ready to retire. Twice. And when they get there, the target doubles again. Because the finish line is not a number, it's a feeling. And feelings are products. You sell to feelings. You build subscription models around feelings. You make the feeling never quite resolved by design. Let me tell you about Raymond, a senior executive in Chicago, 15 years at the same company. Stock options, annual bonuses, a real career with real momentum. His plan was clean. Hit 58, let the vesting schedule clear, and retire. He told his wife, 2 more years. He said that every single year for 6 years in a row. Year 1 of 2 more years almost vested. Year 2, a merger complicated the timeline. Year 3, his boss left, and the new leadership needed continuity through a transition period. Year 4, the transition extended further than anyone said it would. Year 5, his sleep started breaking down. His energy was visibly different. The accumulated weight of being in a company in permanent restructuring was doing what chronic stress always does, quietly, invisibly, until suddenly it isn't quiet. Year 6, his doctor said the phrase pre-diabetic at a routine physical. Raymond retired at 59. Got 9 months of decent health before managing the downstream consequences of 6 extra stress years became its own second project. 6 times 2 more years is not a plan, it's a loop. And the reason it's a loop is that 2 more years answers a math question when the actual problem is a psychology question. Raymond was not staying for the vesting schedule. The vesting schedule was a rational sounding container for something much harder to name. He didn't know who he was without the title. Work wasn't what he did, it was who he was. And the financial rationale was the story he told himself, so he didn't have to confront that. The second engine Raymond needed to build was not financial, it was personal. What do you fly toward, not what are you flying away from? Those are different questions, and one of them is much harder to answer. And I have to be direct about this because it is predictable and preventable, and the system is not designed to help you prevent it. Men who have spent decades being useful, being the provider, being the person with the answers. Retirement can feel like becoming invisible. No performance review, no scoreboard, no clear rules. Open-endedness. That open-endedness can feel like falling, not freedom. So they create a financial justification to delay it. And the financial industry helpfully provides one on request. This is where I move from amused to something closer to genuinely frustrated, because it is a predictable outcome of a predictable system. And predictable outcomes can be interrupted if you interrupt them on purpose. Now, Marcus, I told you his story resolves somewhere useful, and this is it. When Marcus actually ran the 3-number framework, his baseline spend, his guaranteed income floor, his real gap, his reaction went through 3 stages in about 4 minutes. First, skepticism. Second, silence. Third, something that looked like low-grade anger. Not at me. At the fact that the math had always been this accessible, and nobody had ever walked him through these 3 questions specifically. His real monthly baseline spend, tested, actual, not aspirational, is $5,200. Mortgage clears in 3 years, dropping it to $3,800. His eventual Social Security, combined with his wife's, comes to roughly $3,600 per month, arriving at $67 for him. Gap before Social Security at $55. $5,200 per month, $62,400 per year. At a 4% withdrawal rate, that requires $1.56 million. His instinct about needing $1.5 million was directionally right. But with the mortgage gone in 3 years, his gap drops to $45,600 per year. At 4%, that requires $1.14 million. He has $970,000 total right now. He needs $170,000 more. At his current savings rate with normal market growth, that timeline is roughly 22 months. Marcus thinks he needs to work until 62. He actually needs to work until roughly 56, with 1 additional year to build his healthcare bridge and complete a Roth conversion runway for the gap years. He has been carrying a 6-year miscalculation that nobody corrected because nobody ran the real numbers since 2018. He also got actual healthcare quotes, something he had been avoiding for 2 years because he assumed it would be unaffordable. His projected early retirement income structure qualifies for marketplace subsidies in his state. The real annual premium came in approximately 40% below what he had been assuming. One phone call. 40%. 6 years of his life riding on a guess he never verified. He started maximizing his HSA for the first time. For a family in 2026, the contribution limit is roughly $8,300 per year. Contributions go in pre-tax. Growth is tax-free. Withdrawals for medical expenses are tax-free. It is a triple tax advantage account, and Marcus had been contributing the bare minimum for years because he was focused on the 401k, and nobody had explained why the HSA deserved priority as a healthcare bridge fund. After 65, HSA funds can be used for any purpose and taxed like a traditional IRA. It is one of the most underused vehicles in the entire tax code. Marcus changed his target from 62 to 56. He didn't discover a new investment. He didn't get a raise. He didn't win anything. He got clarity. He closed the distance between what the math said and what the fear said. And for Marcus, that distance was 6 years. 6 years is not an abstraction. 6 years of your 50s contains somewhere around 3,000 days. It contains 6 summers. It contains 6 chances at the things your body can still do now that it may not be able to do at 62. The retirement industry never puts that number in the projection. That is the emotional math everyone avoids and almost everyone should do. You are making an investment when you work an extra year. You are investing a year of your life. What is the return? Not just financially. What is the actual return? If that year generates $65,000 after taxes and real costs, commuting, meals, professional expenses, stress spending, the 2 recovery days after every long travel week, and costs you health, presence, and usable time, what is the real rate of return? I can't tell you the number because it's different for everyone, but I can tell you the number is not 0. And I can tell you most people never calculate it. Here are 3 things you can do this week. Not general things, these 3 specifically. First, calculate your real gap, your actual monthly baseline spend, not your projected dream spend. Your tested real baseline minus your guaranteed income floor that exists regardless of market conditions. If that gap is under $4,000 a month, you are very likely closer to the exit than you believe. If it's over $6,000, you have a specific, solvable problem, not a vague, indefinite one. Second, get an actual healthcare quote from your state marketplace. Plug in your estimated early retirement income, which, if you structure distributions correctly, will likely be meaningfully lower than your current earned income and may qualify you for subsidies. You cannot build a real plan on a guessed number. The difference between what most people assume private insurance costs and what it actually costs in a structured early retirement is often large enough to change the entire timeline. Third, run your fee audit. Open every retirement account you own. Find the expense ratio on every fund. Add any advisor fee. Add any administrative fee inside your employer's 401k. If the total exceeds 0.75% per year, run the 20-year compound impact of that fee on your current balance. Then decide with real numbers whether you're receiving value commensurate with that cost. Sometimes the answer is yes, but you need to ask the question with actual math in front of you before you can know those 3 things this week. Before you make another decision about how many more years you're willing to trade, lazy investing built more fortune than crypto memes, and working 1 more year you didn't need to is the most expensive thing most people will spend their lives never calculating.